Good afternoon, everyone. Thanks for joining in. We're going to be with you shortly. All right. Good afternoon, everyone, and thank you for joining us today on our um, webinar on financial planning. I am just waiting for the bank personnel to join in, so I do thank you for your patience.
Hi, Charlie.
Hi, Seth. Good afternoon, everyone. So Mr. Seth Gulcharan is presently with us, and we're going to start now. So good afternoon, everyone, again. Thank you for joining. Hello, Sherry. Hello, Andrew. And all the other guests that we have with us. We thank you for your time and for being here to go through this financial planning exercise. So today, what we're going to be doing, in essence, is actually lending advice, giving guidelines, and in so also sharing our stories to assist each other in acquiring not only from the real estate point of view property, but also financial, what you call balance or freedom. In doing so, I would like for us to start with, and I'm going to share my screen now, and you can feel free to leave us any questions or anything in terms of your concerns in the chat. I'd like to also bring light to our legal section, or the legal department headed by Mr. Andrew Sharp. He is here with us, Mr. Sharp, and as well as he will lend his story, he will also be part of the discussion if needed. Thanks, Mr. Sharp. So we go on to, I think someone's mic is on. If you can just keep your mics muted at this point, but we would love to hear from you. So I'm going to share my screen now. Just let me know if everybody's seeing it. Set?
Yes, we can see it.
Right. So what I have up here is just an introduction of what we're going to be talking about. So as soon as I put up this slide, the first thing you'd be thinking about is, where am I and where do I want to be? And that's the trending thought that we want to leave when we go through this process today. All right. I am just letting in 2 persons. All right. So Esteem Estate Management and who we are is one of the concerns that you would be asked. What do we represent? And ideally, we are a real estate agency that is really functioning in this industry to service the clients with homes and connecting them with the right institutions for mortgages. In doing so, we have made a lot of alliances, but more so, we've made strong alliances with FCB, which we feel very comfortable in referring any of our clients, because they have given us impeccable service through their agents, and also led by Mr. Gulcharan. Just a general information of what we do. Yes, we house individuals, but we also try more so to educate them in terms of the entire process of going through a mortgage, because a lot of individuals are first-time homeowners and they need to be guided through the legal aspect. Hence the reason why we have a whole section or department for legal aid in our agency. And that is something that you can get free, or in terms of free, in terms of accessible, in terms of fees, that is something that we discuss once we get to that point. So in a nutshell, that's what we do. And we keep in mind, we always try to educate and elevate the clients. So if we look at the next slide, which is just introducing our team today would be Mr. Seth Gulcharan, Mr. Ramlokan, and I also see his colleague Rennie with us. So I am glad to have all of you all, and the host, which is me, Shelly. The picture can be a little bit deceiving, but we're here to talk about money. All right, and the last thing that we're gonna talk about today is just sharing my contact information with you in case you need any further advice or any further referral. As I said, I will be sharing the contacts of the individuals speaking today in terms of the bank personnel, so that you can get in contact with them and quickly speak to them on any matter that you feel that you need to address further. So in starting this process, or before I introduce the experts in the field, I want to be able to give you an overview of what we're going to be talking about. And we try to capture all the possible scenarios within this particular video, which I'd like for you all to view. And then from there, we're actually going to discuss and educate and guide you with the expertise of the personnel here of how you can reach your financial goal. So you might not fall in one particular category, but you might be part of each category. So please, if you have any questions or anything that you want to add to the presentation or to the webinar today, please leave it in our chat and we will attend to it. All right, so that was a short video of what we're going to be discussing today in terms of the content. So what you've seen is three different scenarios of clients and their present situation in terms of age, in terms of salary, and expenses monthly. And with that being said, we partnered with SCB to give you some information that will lead to making better financial decisions in terms of choosing how to spend and as well as how to save. So I'll hand you over now to Mr. Gulcharan. And as I said, any information or any questions, please leave it on the chat.
All right, so Shelley, just making sure I would be able to share screen. All right, but good afternoon to everyone. Thank you for the opportunity of allowing us to present some information to you. As mentioned, our role is to educate and to provide options for you to achieve your financial goals. The ability to understand your financial affairs and to plan well. The earlier you do it in your career, the better the outcome is, because in liaising with clients from different aspects, different stages of their life cycle, we've noted that someone could be a very good doctor, an excellent accountant, really a good business person. But when it comes to certain financial points and for certain financial areas, no clue. And so it allows us now to show you how you can plan your financial affairs and be able to understand certain things that can help you to achieve your financial goals. So the theme of our presentation today, it's, let me see if I can share. Yes, I can. So our theme today would be steps to financial planning. And the aim of this, this presentation is to reduce uncertainty. And it's pretty much centered on how can a client be certain as to what is his next step and how can he achieve his financial goals. Now, what is financial planning? Simply put, it's having a financial plan to ensure that your current finances are put in a place or aligned in a way to achieve your future goals. It's really planning now for achieving your future goals. So what's the first step? Well, it's to determine your current net worth. And if it is, you look at any type of financial plan, you get an idea that on the left side, you list your current assets. Your current assets could include what's the balance in your bank account, what's the balance in your unit trust account, what's the balance in your your cash surrender value on your insurance policy. You see, those current assets mean it refers to what you can quickly go to in terms of liquidity, what you can access quickly. You would not necessarily put in current assets, let's say a property, because a property, to get that liquid means that you have to sell or take a mortgage. So that wouldn't necessarily come under current assets. What you're looking at is the assets that you can access quickly. And on the other side, which is liabilities, your current liabilities would be your credit card balance, the loan balances that you have to pay. And what you want to get an idea of is when you list your current assets with your current liabilities, you minus the liabilities from the assets. If it is, you end up with a negative balance. It means that you are in a negative net worth position. Now, ideally, you want to be in a positive net worth position because it means that you have funds to cover your liabilities. But that is not always the case. And one financial goal would be to ensure that you reach a position where you have a positive net worth, both current and long term. Now, what are some things? So understanding where you are as of now is your first step. Another critical area is to understand to where, on a monthly basis, how your income and expenditure flows. Where does it? How is it? Where does your money go to? So simply listing on a monthly basis from your salary. Yes, you have some that is taken out for tax and NIS and health charge. You can't do anything about that. But the difference, however, of your salary, how much goes to bills, ensuring that you have food in your cupboard, fees for your kids, and the routine expenses that you have month to month. You list that, but there are some that might surprise you. I mean, yes, we are in an environment where we are more home, but pre-COVID, you would find that a lot of expenditure in buying food or entertainment, that when you add it up over the weeks and months and on a monthly basis, that figure can be a bit of a surprise. And what you want to understand though, is that when you look at your cash flows, what you spend on a monthly basis, is any going to savings? And that's an important factor because to get your financial goals in the medium or long term, it means now looking at what your savings, what you're putting out for savings, the more you do that on an earlier basis in your life cycle, the more you can achieve. So now that you understand where you are, you want to develop your financial goals. And as mentioned, there are some things that you want to do on a short term, intermediate, and long term. So a long-term goal might be acquiring a house, because immediately you might not be able to go into a bank and say, okay, I want a property, finance this for me. Because of the requirements, the loan officer, one of us might tell you, not just yet, you have to achieve X, Y, or Z. And how you reach there is this is the basis for our discussion today. There's an acronym that is used when it is developing your financial goals, and it's using a SMART goal setting process. And the acronym, pretty much to be specific, to be measurable, attainable, rewarding, and time-based. It's one of the more common acronyms used with regard to financial planning. But it's broken down in a way that if you put it in a way that, what is my goal? How can I measure it? Is this attainable? What is the reward for me? What's the time frame in which I want to achieve it? If you put that in any area in your life using that SMART acronym, what it does is it breaks it down in a way that you can see how to achieve that goal. In developing your financial goals, you have to understand what are your financial values. Now, some people, because of their parents' example, they develop early, strong financial values, such as saving, such as ensuring that what you make is what you spend. Some negative financial values could be, well, as soon as I have money in my hand, it must go to entertainment, or it could go to some level of enjoyment, or even buying assets that depreciate, that over a medium or long term will actually go down in value rather than increase. That type of understanding financial values means that you may be able to ask yourself, am I encouraging or building proper financial values that could lead to my long-term success? And sometimes you might not see it, so you bring your family into the conversation and you ask your spouse or a trusted relative, what do you think about my spending or my finances? Do you think I can improve in any way? Sometimes there may be a different point of view that can help you to understand some things that you might have missed in your values. So a family member say something like, you buy a lot of food outside. It might be a normal day-to-day thing that you're accustomed doing, but someone else letting you know that might help you to realize, maybe if I try to save funds based on maybe cooking rather than purchasing, that can be something that can help you to save. So develop your financial goals. The third step, well, this is still part of the second step. One of the things that we have noticed is that many clients come in, they have their job letter, pay slip, they have a year or two in terms of their tenure in a certain environment, and they think to themselves, okay, I'm ready for a loan. Typical goals that we encounter would be, I'm ready to purchase a vehicle. Now, financing for vehicles have become so very easy. Different financial institutions offer 100% financing, cover fees. So you pretty much could walk out of a financial institution with an approval to buy a vehicle. You don't have to cover any fees. Even in first year's insurance can be covered. Considering this financial outlay, this financial investment, have you considered that a vehicle would have maintenance costs, tires, battery, things that are not covered maybe by the warranty, but you would have to put aside funds or find funds in order to ensure that the vehicle is maintained? What about the second, third, fourth year insurance? Now, vehicles that are financed by institutions require full comprehensive insurance. And that is a cost that it's an annual fee. You would have to find funds year 2, year 3, year 4 to cover that as well. And servicing costs. To keep warranty for the new vehicles, you would have to carry the vehicle at a certain time frame to be serviced at the firm. And that is an additional cost as well. So in developing your financial plan and saying, what is my goal? I want to have a vehicle. It's not just acquiring it and jumping in and drive. It's about understanding that year 2, year 3, year 4, there would be costs that you would have to put out in order to ensure that you get the value of the vehicle and to maintain your being able to drive this vehicle on the road. Some coming to and they say, well, I've seen a property and I'm interested in buying it. And it's a townhouse. I love it. It's in a good area. It's in Bamboo Creek. It's brand new. My friends have been qualified to purchase it. And you now want to get into a lovely property like that. Only to realize that the bank officer, one of us, will be telling you, well, do you have a down payment? Can you cover the insurance on the property? What about the closing costs? Do you know that there's a bank fee to pay for this? And then you realize that at this point, yes, you have a job, you want to be able to move into your own home, but I didn't know what these costs to put out in order to afford a property. So many of our interactions with clients, it involves helping them to understand this financial information, helping them to see that in order to reach that stage, it's a process. And 2 key items of being able to have a clear view of where you want to reach and to be able to attain that is in attaining a credit score and ensuring that you have a savings plan. Those 2 things should be major financial goals. Another item that we explain when it is we're helping others to understand about their financial goals is debt servicing ratio, or DSR, is a key item in understanding what can you afford. Now, what is DSR? Well, put simply, it's a method used by banks to calculate whether or not you can qualify for the loan that you're applying for. The requirement by most banks is that your total monthly payments to credit facilities must not exceed 40% of your salary. So for simplicity, if you have a salary of $10,000 a month, the monthly payments that we use to calculate your debt servicing would be, is it that you're paying any rent? Is it that you have a credit card? If you have a credit card, we look at the limits and use a percentage of the limit as a monthly commitment to keep the credit card going. We look at any loans that you're paying. And we also include if you have alimony, or if it is that you have any, so those are the items that we look at. So we add that up and we look and see what is that amount, and we compare it to your total monthly income, your gross income. Now, someone whose income is 10,000 and they said, you know what, I need a vehicle to get to work. So they have a vehicle loan. So that's 2,000 that they're paying there already. You might say, I want a property, I want a Bamboo Creek property. Well, interestingly, let's just let you know that your qualifying amount for a mortgage over a 30-year period is just 350,000, just enough to maybe to look at a parcel of land in certain areas. In other areas, you might not be able to qualify for that parcel of land. So many of our customers, we have to actually give them this information now that based on your current situation, you cannot afford the $1 million property that you may see being advertised. And you definitely have to consider alternate options to qualify for a property of around $1 million. So what do you do if it is you at 10,000, you have a vehicle loan? Here are some alternate courses of actions. You have to study the options available to you to meet your financial goals, and that this goal can be met in a multitude of ways. Here's some critical things that you need to do. Select your strategies so that you can complete your financial plan. All choices involve opportunity costs. Research your decisions like a scientist. So you see the person in the picture considering, should I spend money on a new vehicle, or should I save on a new vehicle, probably buy a roll on roll off so that I have more disposable income at the end of the month. It's uncertainty, yes, it will always be part of the picture. But what is certain is that if you keep a savings pattern and you ensure that your credit score is good, you are in a better position to afford a facility at an institution. Now, look at the big picture. Sometimes you might see an advertisement with a brand new car and you might be able to afford it, yes. But would you live in a car for the rest of your life? Or is the bigger picture being able to look at moving into a property at some point? Decide which goals you want to pursue now and develop a budget that incorporates your financial planning goals. So how can you, and earlier in the presentation, you mentioned two critical things: having a credit score, good credit history, and a good savings pattern. Why is this important? Well, it increases your chances of accessing favorable borrowing options. Banks like to know that you have a good history both in savings and making payments as well, and you get better rates from us, better terms. So when it is we assessing an application, we pull a credit score from a client. Now, a credit score in Trinidad and Tobago, we use an agency called TransUnion, and they would pull from most of the financial institutions, payment histories. And from your payment history, they ascribe a score for each person who is looking for a loan. Now you might say, well, I've never borrowed. Well, pretty much your score will be 0. That would be your score. Now, any score over, let's say, 550 and up is good. Excellent scores are around 700 and up. By simply paying a credit card, ensuring that your monthly minimum payment is maintained month to month, that actually contributes to a good credit score. So some people might say, well, I don't want a credit card. I find like I will spend too much. Simply getting a credit card and using it how it's supposed to be used, which is if you use a credit card to make your monthly routine expenses, you use a credit card for that. And at the end of the month, when you pay that amount back. What that does is ensure that you have a good credit score, but it also ensures that you're using your credit card to work for you. Because when you get a cash back option or even points from using your credit card like that, it is one of the few ways in which you're paying for expenses and you're getting some value back for using the credit card to do that. Other than that, if you use other cards, let's say a debit card, you actually have to pay a fee to use that card. But with a credit card, you may not have any fees at all to pay. You might actually get back funds from the bank in terms of value. If it is you use credit cards for routine expenses and you clear that amount within a specific time. All right, so that is one thing that we can say as a bank. If a client uses a credit card well, they build a good credit history and they actually benefit from the value, either points or a cashback option. Now, earlier in the piece, we talked about someone who was paying a car loan, $10,000 a month, and could only have qualified for about $350. But let's build out now to a medium-term scenario where that person now decides to, along with the payment to the vehicle, they put aside funds on a monthly basis. If that person, if you look to the bottom of the screen, in 3 years, puts aside $3,200 a month, they would be able to save approximately $114,000. Or 4 years, $2,400 a month, they can come to that figure. And in 5 years, $2,000 a month to come to that figure of $114,000. What that can do? Well, for $50, that person will be able to make a down payment of 10% and the closing cost of around $40,000, so 35 to 40, be able to cover that as well. Now, the key to this slide is to achieve certain goals. It means that we must look at putting aside, allocating funds on a monthly basis for savings. And in maybe 3 to 5 years, you might move from a point where you couldn't qualify for about $350 to a point where you most likely can qualify for about $750. And so that's an interim goal, because interestingly, $750 is not going to get much options in the market. There are some, but they are, just being able to qualify for more by putting aside savings, it's improving the possibility of you qualifying for some type of property. So understanding now where savings can get you, credit score can get you, you review and revise a financial plan. Think of a financial plan as a working document, something that changes, something that's fluid. At one point, you might think it's important to travel, to experience new places, but understanding too that that might actually be a debt on the books for another 3 years that you're paying out for this travel loan that you've taken. You might say, you know what, let me go to Tobago, for example, apportion less money for that and save more. Now, your financial plan is working, it's fluid, it's adjusting to what you want to achieve in a medium term. Review your plans on a regular basis and discuss your financial plans with a trusted relative or your partner. So how do we reach the end game now of being able to qualify for $1 million? Well, using the instance, and Shelley had different scenarios, Joe, Jane, John, different scenarios in different cases where somebody's working for 20,000, somebody's working for 10,000. But using an example of someone who, let's say in 2 years, first 2 years of their career, working for about 10,000, minimal savings, they pretty much purchased a car, they're paying 2,000 a month. If that person had put aside a plan where they're saving about 2,000 every month over a 3 to 5 year period, and in that period, they would have gotten a promotion or two, or their salary would have gone up. That person, let's say they started to work at 25, 26 years. By the time they're 30, average salary of 15,000, they've over a 3 to 5 year period, they can qualify for a mortgage over a 25 or 30 year period. At that point, based on the model we showed, the estate would have had some savings based on putting aside on a monthly basis, 2,000 or so. So they have savings of 50 to 100,000. They have a good credit score because they may have paid their credit card well, and they already have an established relationship because of the number of years they've had an account where they put in aside funds, they pay their credit card well. Look at this. They can qualify for that $1 million because with 100,000 down payments to the $1 million, 900,000 at 4.5, which is the average rate now for 25 years, is about 4,700 a month. And that is, when coming to debt servicing, that's just about 30% of salary. By that time, the car loan should have been paid off for, just the credit card remains. So the credit card minimum payment and that 4,700 going towards a mortgage. Person comes to us at that point, they have their savings, they have their down payment, they have average salary of 15,000, loan is approved. We tell Shelley, basically we're pre-qualified as client. Yes, they can qualify for that $1 million. So this process here, moving from a situation where salary is about 10 to 15,000 within a 3 to 5 year period, building that savings in between and also building a credit score, the end game of being able to qualify for that $1 million can be achieved. So that brings us to the end of our presentation. Thank you for your attention. And if you have any questions, feel free. But let me hand you back over to Shelley and I will look out for any questions.
All right, thank you, Mr. Gulcharan. Excellent presentation. And we have a full deck today of individuals. We also have a question that is on the chat, and I know that your agents are on it as well. And yes, we did talk about credit score. I will offer this time period to talk about any questions or concerns that you'd like to share. But before starting that, I would like to introduce one of our actual clients, Ms. Sherry Ann. And Ms. Sherry Ann is presently purchasing a property, and we'd like her to share the experience, because as a client, not only with Esteem Estate, but as a client trying to acquire property, there are many challenges. And we want to lend to that experience and be able to give support, not only through the agency of just providing a home, but also through the bank. And you'd realize from the conversation here, we are very patient, we are very knowledgeable, more so Mr. Gulcharan, and We also like to take the time to help the client through the process in terms of learning, because we expect this not to be the first and last transaction with us. So Sharianne, are you able to put on your mic at this time?
Hi, Shelley, you hearing me?
Yes, I'm hearing you very well. Thanks for joining us.
Sure.
So,
Okay, so
mhm,
good afternoon, everyone. Just in terms of sharing my experience, as Shelley indicated, I'm a first-time homeowner. I'm also a banker, and based on Seth's presentation, I was very well aware of that entire process in terms of doing your proper savings and putting aside in the event that based on the stage of life that you're in, you're ready to purchase a property. So I'm very well aware of that information. However, I've never been the type of person who was interested in owning my own home. Reason being, I'm renting presently, and my father added my name on his property. So in my mind, I'm thinking, okay, I have at least my name is on a property. So I never thought about owning my own home. Now, after doing the viewing of the property with Shelley at the Bamboo Creek Villas, I immediately changed from not wanting to own a home based on that experience of viewing the home to becoming a first-time homeowner. That being said, based on the stage of my life I'm in, I recognize based on my age and based on my age to retirement, the window for me in terms of the acquiring the mortgage for that particular period of time was short. So I recognize that my installment is high. Um, if I decided in the past to pursue a mortgage at an earlier age, I knew that my installment would have been less. That being said, everything happens in a time and for a particular reason. So I'm very happy at this point in time that I have actually decided to become a first-time homeowner. And that has never been anywhere on any of my objectives, yearly objectives for the past 5 or 6 years. And after again viewing the property, I decided that this is something that I want to pursue. And it's crazy because I'm like, oh my God, God has a straight sense of humor because I am going to purchase a property during a pandemic. That being said, I believe that I'm walking in faith and I'm moving ahead with the process. I've already made my down payment and moving forward with the transaction. My experience with Shelley has been exceptional from the moment I met her during the viewing of the property. I found her to be very professional. I love her honesty. She's always accessible, and I think she's very genuine in terms of what she's suggesting. Also looking forward to closing the deal with her, continuing guidance and support. I also want to I've had some interaction with Seth as well. I'm also attesting to Seth as well, by the way, because during this process, while I did not choose FCB to finance the mortgage, I did have some conversations with Seth during the process. He was extremely helpful. I think at some point in time when I was contacting him, he was on vacation. However, he was responding to my messages. He was responding to my WhatsApp. He was giving me contact information for someone who can help. And every single time I call him, he always makes himself available. So that's my experience. I'm very happy with the process thus far and my interaction with Shelley throughout the entire process.
thank you, Sherry. Thank you again for that excellent review, more so on the process that you've gone through mentally in acquiring your home, and also the experience you had with us. We do appreciate that. And it helps when you hear it from an external party than just the company that you're working from. One of the things I'd like to indicate, and we would go to the questions in a little bit where I'll ask Mr. Gulcharan to respond on the chat. I'll be reading it for you. One of the things I realized in being in real estate is that we have a lot of clients that are familiar with the term mortgage, but not familiar with the process of. It might have been, we also have come across clients that even went through a mortgage, and they sometimes learn more in the process now than before, simply because somebody is taking the time to assist them through. It is one, and that's one of the things that we state on our website. Real estate is not just selling a property. It's a technical and as well as an emotional, whether you're buying or selling, there's a connection there. And I think you heard that when Sherry was speaking, when she went through the mental process of buying and so pursuing the sale. So let's go quickly. If anybody wants to say something at this point, I will read out the question or try to get the gist of the question. I think Mr. Ramlokan, as usual, is doing an excellent job with the chat to explain the credit score. Does anybody want to add to the conversation in terms of they want to ask any particular question that we can address at this time?
I just wanted to add something to the answer to credit score. All right, so many people may not know that a postpaid plan with Digicel is actually something that shows up on your credit score. So many times, by not ensuring that your postpaid plan with Digicel is up to date, that can negatively affect your credit score. Just a note.
Thank you, Seth. I didn't know that.
Yeah, and just to mention too, so with a credit card, it's not necessary to pay off the entire balance of your credit card month to month to keep a good credit score. It's ensuring that you maintain or you pay the minimum payment required. One of the questions asks, what is the amount that we look at in terms of debt servicing for a credit card? It's 5% of the limit, 5%, because that's what we average. If you pay at least 5% of the limit, you surely will cover the minimum payments on a month-to-month basis. So that covers two questions. One question, what is the amount we look for in debt servicing? It's 5%. And if you ensure that you make at least 5% to your credit card month to month, you will ensure that your credit score is actually improving as you keep doing that consistently.
One of the questions here, what are the benefits of a good credit score?
All right, so to illustrate, someone with a credit score of less than, let's say 500, could get a rate as high as 6.75. Compared to someone with a really good credit score of, let's say 700, that rate could be as good as 4.5, 4.75. So there's a range in terms of interest rates that would apply based on someone's credit score, someone's debt servicing, and how much you're putting out into the property. That can define if your rate is as low, less sub 5 to even 6 or higher than 6, depending on how good that or how good your credit score is.
I wish I knew these things earlier. So Seth, I know that our candidates here would love to ask other questions, which I'm going to give them the chance to do. But I have two questions that I would normally ask clients. Well, I have one question I would normally ask clients once they call concerning a property. And as you rightly pointed out, I would direct them to your office and then you give us the feedback. And the process in doing that is very timely because we had made an arrangement of 24 to 48 hours. And I must admit that your agents are beating that time. So what I would ask is, as soon as you call and you're interested in any of our properties, I would ask, are you approved or are you pre-approved? And many times I would be asked, what is that? Or are you pre-qualified? And then I would explain to them the idea of going to the bank. But one of the questions they would always come back with is, how do I do that? And why should I get pre-approved or pre-qualified? Now, from the real estate point of view, in acquiring a home or even going into buying any other entity, whether it's a car or anything, you would want to know your spending limit. And that is how you would be able to identify whether you're searching in the right place or you're searching within your budget. So can you lend us in terms of what the pre-approval process would be like?
Sure. All right, so 3 factors we look at. One would be, we look at what is your total payments to loans at this time. So in terms of total payments to loans, what we do, we look at 40% of your gross income, whatever that figure is, less your current payments to other loans, rents or alimony. Whatever that difference is, we take a note of that figure. The second item in which we look at is what's your age. Now, age from where you are now to your retirement age, and in some cases that might be either 60 or 65, depending on the industry you are in or the business that you are in. We look at that time frame, and we also look at if you have a good credit history. As mentioned, your good credit history could affect the interest rate that would apply. So those 3 factors, we're able to input 1, 2, 3, the amounts left between 40% minus your current payments to debts. That's 1 factor. The interest rate based on your credit score, we'll be able to gauge. And the 3rd factor, your age from now till retirement age. We put that in and it generates an amount. And that amount is pretty much the amount that you can qualify for a mortgage or long-term financing. So it's an easy process. Most of the times we ask simply for a copy of a person's ID and their payslip, and we're able to generate a pre-qualifying amount based on those 2 documents.
Excellent. And that helps us to identify what you can and cannot purchase, but it also helps you in terms of being able to search in the right direction, because as we all know, purchasing a home or in these times any investment is something that you want to think about the long term. So the idea of being here today was not to talk about only mortgages, but also to give you the idea of or give you the information and guideline in terms of balancing or planning your future through the pandemic. And FCB is well equipped to do so. We understand that it has changed a lot for a lot of individuals, but we are still here to assist the client through the process. One of the things that we are built on Esteem Estate, and we also find common grounds with FCB, is that we try to build long-term relationships with the customer. So Seth would also lend to that when we talk about, yes, you might come to us today and ask us for a property, ask us for guidance, and you might not buy tomorrow. You might buy 2 days down the line, you might buy 20 days down, you might buy 2 years down the line. And we've realized that. But the good thing is that we are able to guide you. We're able to give you that direction to assist you in becoming better at financial goals or planning your financial goals. Seth, you want to add anything?
Yes, and so as financial advisors, we look out for how can we help clients let's say a certain price range for a vehicle.
You want to repeat that? You broke up.
Yeah, sorry about that. Yeah, so many times we provide advice such as, someone may be looking for a certain price point for a property or even a vehicle, for example, or maybe to use for furnishings or travel and so on. But what we try to do is help the client to see would this really be benefits in your short, medium, long-term goals, as mentioned in presentation. And sometimes it might be something, maybe a suggestion like maybe look for a cheaper vehicle, or maybe save up a bit more to acquire a bit more down payments to get the property that you that would be ideal. Those are some suggestions that we try to make so that, you know, we assist the clients in getting there, helping them achieve their best financial position going forward.
Right.
I did note, Shelley, two very interesting questions in the chat. One is from Josanne: how can a person check their current credit score? Just to answer that question, if it's okay. All right. So, as mentioned, the agency that would handle credit scores in Trinidad it's TransUnion, and you can get a reference to check your credit score from any bank. If you go into a bank and you ask for, there's a reference that you can get from a bank, and you can go and get a credit score. You can also search up TransUnion, and there's a process with them that you can apply to get your score. It's a small fee, but you know, that's a process that you can actually engage TransUnion to understand what your credit score is. Another important agency that we utilize is AVNOLS. AVNOLS would track any type of bad debts, judgments, and so on. AVNOLS is another credit. They would not give you a score, but if there's any history of bad debts, they would. So if it is you have not paid, let's say, courts or standards, and there's an outstanding amount, most likely it would be reported in the AVNOLS agency, and that's another agency that have to probably check to make sure there's no outstanding amounts there, because that is something that will show up, and it's part of the credit check process. And there's another one here from Jocelyn. If credit score is damaged and not working now, how to build back credit score? Very good question. What we normally suggest is a short-term, fully secured loan. Short-term, fully secured loan. Because what happens is when you have a difficulty with credit score or credit score issues, getting unsecured borrowings can be an issue. So what we suggest is that you maybe for a year take a fully secured loan. It could be 10, 15, 20,000. Pay that back as a range. The thing about it is that if it's fully secured, it represents no risk to the banks and the approval is easier. However, it would be a scenario where you have to show some level of income generation, where you can show that you generate an income month to month. So as soon as that you're in a situation with where you can show that, as mentioned, look at a fully secured facility for a short term, take that out, pay it off, and then you'll be in a better position with the bank where you've shown you've paid this debt. You have some levels of savings, and it will improve your credit score.
Excellent, Seth. As the questions keep coming, I also want to remind individuals that yes, the reason why we started to do this process now, which is financial planning, which is a series which will go on, and once you have come to this webinar, we would advise that you send us a WhatsApp at our contact number, and we would add you on our listing to send you the other links for the webinars. Now, why we're deciding to do it now is not only that we normally do webinars every month or two, we want to be able to show you how to reach that financial goal, not only through the pandemic, but as we come out of a pandemic. So once we've seen things open up, and I know that Seth referred to taking that vacation in Tobago instead of other places, what we're talking about is simply choosing based on your financial needs and goals right now. And that is very, very much important. Now, I also want to touch on something else that is external to what we're speaking about or is not in line right now. And I shared this screen for a particular reason. This is a luxury apartment found in Palmis. It's called Burlington Courts. And our agency carried this property as an exclusive. And one of the things that I want to share with you is the fact that its price point is actually $3 million. So it's not the $1 million budget, but the property is extremely luxurious, as you would see. What I have been asked multiple times, even at this property and other properties, we would stage a unit just to show the client how the property looks. And they will quickly ask me, because of the type of staging we do, and because it's eye-catching, etc., they would ask us about fully furnished. So they want to do a mortgage and they want to buy all of the furniture there. How would the mortgage be done, or in their language, would it be covered by the mortgage? And this is a question that I'm normally asked, and I will ask for Seth to respond to that, because I think that he would be better able to deal with that matter. Seth?
Let's just repeat the question, Shelley.
Right. So the question is, you are buying a property, but you want it fully furnished, like the display unit, which you would normally hear. How do you address that? And I know that you can pull from the present experience we're having with a very well-known Bamboo Creek.
So when evaluation is done, evaluator will assess the land value and the property. The property value would incorporate the lands, the space of the building, and so you get the evaluators apportion a value of the property space as well as the land space. Furnishing, however, will not be included in that valuation. A valuator that you get for a bank normally would cover the house and the land. So what you have is that the price point of a fully furnished property would be in most cases more than how much the valuation comes in at. All right, so just to give you an illustration, the value of the purchase price might be 1.7, but the valuation may come in at 1.5. And it's simply because valuation doesn't take into account furnishings. Now, what the bank will do is the bank would look to finance a percentage of whichever one is lower. So if the purchase price is lower than the valuation, we would do a percentage of the purchase price. If the valuation is lower than the purchase price, we lend based on the valuation. So in this case, if, for example, we require from that particular client, we would only give 90% financing based on the analysis of that client. We will do 90% of the lower, which is valuation, we do 90% of 1.5. That's how we would assess that scenario.
Okay, so a generalized question that's found on the chat right now is, why are banks most of the times adverse to funding rent-to-own properties?
All right, so we would need a bit more information because with rent-to-own, if this answers the question, what happens when we do a mortgage is the property is first conveyed to the clients. So the ownership is with the clients, and then the client mortgages that to the bank. Now, in order for conveyance of the property to the client, it means that the vendor gets all their funds, what they're calling for in terms of, so if they're calling for 1.5, it means that by our financing and the client injection, the vendor is paid at 1.5, he signs over the property to the client, and the client would mortgage it to the bank. For rent-to-own properties, if there's a scenario where there's an outstanding amount owed to the vendor, we would then be unable to mortgage that property, because in most cases that vendor is not going to convey ownership to the client. However, in some situations where the person would have paid, let's say, rent to own, they would have paid, let's say, 2 years. Equity injection. So let's say the property is $1 million, and in 2 years, the person paid 100,000 and they owe 900,000. Then that's a good scenario because the customer's already made an equity injection. So if it is we finance 900,000 along with what the person already paid 100,000, pay that to the vendor, and the client can get the ownership and then mortgage it to us, that's fine. But if it's there any situation where there's still outstanding amounts to the vendor, that's a situation where we'd be adverse to funding that. If that answers the question, I'm not sure. Josanne?
Josanne. Hi, Josanne. Okay.
Okay.
Maybe she would type it. Yes, she typed it.
Yes.
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 Yeah.
So anyone else would
All
like
right.
to go ahead, Seth?
Yeah. And in some situations, the rent to own comes up because clients are unable to qualify. So if their debt service is higher than the 40, they may not necessarily get through with a institution for financing. But for some reason, they are able to afford more than 40%. They may get into a rent to own situation where they pay the vendor a specific amount on a specific period. So that arrangement is ideal because the vendor takes the risk and not the bank. Because and most cases it's a scenario where because of the percentage in terms of the debt servicing, the customer cannot qualify with the institution. The rent to own comes up as an option where the payment goes to the vendor. But that's more of a private arrangement rather than the bank. So it's simply where the banker would be unable to qualify the person based on debt servicing. But if the person's debt servicing condition improves, maybe in a later date, so later time, they can come to the bank for finance and then.
All right. So I think you really helped these individuals here. Josanne said thank you, and she understood. One of the other aspect of the financial part of acquiring property or any other asset would be the legal part of it. And that's why, as I said, we have added that entity to the business of the agency to assist clients. But I also know that the bank is aligned with evaluators as well as lawyers that they prefer or they have on panels. One of the things that we spoke about previously is valuation, and you made mention of that. So let's say a scenario where you have a valuation that comes in lower than the price that let's say the person is marketing it for. What happens with the mortgage? And I think you touched on that, and you said you would only be able to finance up to the valuated price. Am I correct?
Yes, correct. And it's becoming a bit more of in terms of how many times this would occur. We're seeing that it's likely to occur more and more because in the current economic environment, if it is that you have a robust environment and you have demand, so once you have high demand for properties, you find that the price would go up based on market forces. But because of the current environment where it's pretty much a stagnant economy, valuators have become more conservative. So whereas they would have been apportioning a value for a property for X amount, it's now less based on the uncertainty of the economy. And so the property that may have been valued at 1.5 maybe 2 years ago may not come in that amount based on how the evaluators are now assessing the economic environment and also looking at, they also look at if there are any sale of properties in that area, whatever the sale prices that can affect future values, because there's a method in which valuators will look at in terms of coming to a particular value. And so, yes, there's definitely a scenario where if it is a customer is looking at purchasing a property, obtaining a valuation as soon as to help, because the amount that you can qualify for with an institution will be affected because we look at the lower of whichever is lower, if it's the purchase price or the valuation, our financing will be based on that amount.
Right. And so, sorry.
So just to illustrate for this, the value is $1 million and the purchase price is 1.1. And we're doing 95% financing, which is actually an option right now. It means that we wouldn't do 95% of 1.1, we do 95% of 1 million. So our loan will be for 950,000.
Excellent. So one of the things that we would hear in this particular time is this is a buyer's market. Simply because, as Seth rightfully explained, a lot of people would be able to sell their would have to sell their property because of different situations that they're going through, but more so the prices would be different in terms of valuation. So valuation report is very important. In terms of developments, you find that you have a blanket valuation and the client may or may not have to do an individual valuation. So that's a cost that you don't have to accrue. Also, one of the things that we add to the client in any purchase is home insurance coverage. And I know that this is a requirement for a mortgage, but why do you need this insurance coverage set?
So it's simply protecting the investment both for yourself and the bank. Home insurance would provide some relief or a payment in case of a natural disaster, in case of earthquake, hurricane, and we are in the hurricane season. So if something happens, if a hurricane passes and there's damage, there will be some level of damage or fire. It means that our your investment and our risk that we have taken to give funds using this collateral support would be covered somewhat. So home insurance is a critical part of protecting your investment, as well as ensuring that the bank's financing of that property is secured somewhat by in case of a natural disaster, in case of a fire.
All right. And therefore, you would understand why we would have included it, not only to save the clients in terms of the expenses or the fees that would be incurred in a mortgage, but also to ensure your property is secured, right? Anybody else has any other question or would like to add to the conversation? I'm trying to wait on one other person to speak, but he's having difficulty. All right, so basically we have covered this particular part of financial planning, and with the next seminar coming up where we will be looking at not only mortgages and financial planning, but we're also going to be looking more to the legal aspect of acquiring and getting your mortgages. We would be talking about that in terms of your purchase agreement, in terms of closing, all of those things again. So if we have no other question, I would like to thank Mr. Gulcharan and his team for being part of this webinar, as well as every member that has joined on and used their time, contributed with a question, or just simply listened on and would obviously call us to ask us any other question. We're here to support. Thank you again for all being here, and I wish you a great weekend and see you at the next webinar.
Thank you, Shelly-Ann, as well, and thank you, Sherry-Ann, for the fine testimony. We're happy to help, and we hope that we can help many other clients in the coming weeks and months. Thank you again, Shelly, for the opportunity.
Take care.